Greetings, everyone. I hope all is well. LaTerrence Williams, we're not going to hold you long tonight with waiting, right? We're not going to hold you long tonight with waiting. What we're going to do is get at it. We got a very, very great presentation that I think that a lot of people will benefit from. One being we all need funding. We all need money, and we all need someone to bring that to home to us, right? And with some investors can start off with that one hesitation that I don't have the funding, I don't have the money. And then you have some that been investing so long, they're over leveraged and like, what do I do now? What do I do now? So the person that's going to speak later on will be that person named Clint Hooper, which is going to introduce to you what do you do now at that moment when you're over leveraged and you have too much going on. And when you get started, hey, I got some tools for you. I got some gadgets for you as well, but I don't know if these gadgets will be the best one for you. But I know that once you get to that point where you're a superpower and you just don't know what else to do, I definitely have some ways for you to keep doing business in your business name and making money. And he'll let you know more about that. That's just a little snippet about what to come. Next, we're going to talk about Joe. He's in the Chicago area right now. He's doing big things. He flew in today. I just spoke with him before the call, and he said nothing but great things about how he excited about what today hold, right? What happened today, what tomorrow hold, and what's the future hold. So I'm glad that you all are tuning in and listening in on this. I'm glad that you all are having an opportunity to witness the change in the world right now, in our world. Maybe not your world, but our world. And we want you to join the forces with us so you can have a change in your world as well, right? So Joe, unmute, man. Tell me about how things going if you can, if you're in a place where you can speak real quick, give us a little update or what have you, and then we can go from there, brother.
Well, brother, hey, I gotta tell you something, man. Hey, look, I'm fired up right now. I'm in the hotel. Yes, I made it to Chicago, but man, some great things, man. I'm sitting here at my desk. I'm jamming to some Sunday service by Kanye. Man. Hey, look, man, this dude. Hey, man, look, they got me on one today, man. Life is good. Hard work, dedication, commitment is definitely starting to pay off, Coach. I want to say thank you for several reasons, but I'm just going to nitpick on one really quick. So last week we had the conversation, and we just consistently go back and challenge each other on developing processes and ideas on how to get better. And so one of the things you said, you're like, man, Joe, I know what you're doing out there, but shoot, I just don't know all the tricks. To the trade, I don't know I don't know how it's going. And so I said, you know what, Coach, you're absolutely right. I have not taken the time to actually document the process of how I go about finding opportunities, funding opportunities, closing on opportunities. Now, funding opportunities does not always mean that I'm the one actually purchasing them. It does not. It means that, hey, look, as you teach the wholesaling, transaction, hey, I do a lot of wholesales. My goal is to buy a property a month, wholesale a property a month. And you said, look, I know what you're doing. I just don't understand how you're doing it. And so, Coach, because of that, what I decided to do is go ahead and document it. And once I documented it, I said, I'm going to stick to the script myself, because I get weary because from wholesaling, buying and holding, dealing with rental properties, project management, budgeting, all these different things, it sometimes it's hard to stay on that path. But what I did, Coach, I documented the process. I say, you know what? Now let me execute this process. I said, let me execute it. So I'm proud to tell you, based upon the documentation, and I took action, implemented it, documentation for implementation. Boom, Coach, I got 2 properties under contract. 2 properties under contract. And whenever I say under contract in less than, what was that, 72 hours? Less than 72 hours. And got another one in my inbox right now to where they want to renegotiate the purchase price by $5,000. Renegotiate the purchase price by $5,000. So I'm excited. I am excited because now I have options. I got options. But coach, I got to give you, hey, a large piece of that pie, a large, piece of that credit, because without you, encouraging me, challenging me to, hey, document this so we can share this with other people. Exactly the step by step. It is not hard. Oh, when I tell you it is not hard, it is not hard. And I'm also excited to say that those that are actually, your mentees, I'm actually going to teach this to them. Teach this to them.
Excited. I'm excited. I'm excited too.
Follow the process. Boom. You know what I mean? 1 in 10. 1 in 10. You will have one property under contract within 10 days. Within 10 days, one property under contract. So man, there's action and follow through. Action and follow through. And above the action and follow through is commitment. So, coach, man, I'm fired up, man. Today was a good day. It was a good day. Good day.
Okay, then, Ice Cube.
Man, look. Yay. Hey, look, I looked at projects I have that I'm working on, that I have going on. Because I had I guess you'd call it a heated call with my contractor. And I'm like, hey, your guys over there tiling my bathrooms? No, they're not gonna say, hey, look, hey, they're supposed to be finished by Wednesday. Like, well, hey, look, if I can get somebody over there, it's gonna cost me a little bit more money. I said, I don't care what it's gonna cost you. And I said, and I mean that respectfully. We have a deadline and a timeline that we got to stick to. I got to pay you every single Friday. If I'm not paying you on Friday, something wrong. Something wrong with either you're not getting the work done or I don't have no money. And right now I have money. So, and he was like, well, so exactly. So you know what happened, coach? Midday, he had another guy in there tiling them bathrooms. He had picked up that paint to start painting my ceilings, because now I give him the process. Nope, don't go in there and paint my ceilings first. Paint them first. All my ceilings from 3rd floor, 2nd floor, basement. Now go paint my walls from the 3rd floor, 2nd floor, now basement. Now put my floors in. 3rd floor, 2nd floor, now basement. Now put my trim in. 3rd floor, 2nd. So now, hey, we on the chart. We on the process. So, coach, man, I know that was a little lengthy. Not to steal any thunder from Clint, because I know he's definitely going to bring it. Every man that I know by the name of Clint definitely got that killer mentality inside of him. So I definitely know he's going to be able to get the crowd riled up, ready to go, fired up. And I tell you one thing, hey, look, I'm ready to borrow some money from him. You know that? I'm ready to borrow some money from him.
I appreciate it, man. Look here, I don't want to give no shout out to him now. You done did a good interview. I mean, a good welcoming. So listen, well, with that being said, I'm gonna piggyback off that real quick. I met Clint at my first investor meeting group up here at Brown and Groups, that I go to networking events. I try and go at least 2 a month, and that's one of them. When I met Clint, he's very down to earth. He came at me with, how can I help you close more deals? Here's my number. Here's my card. Please call me ASAP so we can work on you closing more deals with whatever tools I have for you. So that's the person he come across. And I promise you, once I go and turn my camera off and this guy come to the screen and he come on, you're going to see that same personality, a person that's down to earth, willing to help, willing to serve, and willing to do the work. Right? And that's who we want to work with. We want to work with go-getters that does not mind giving. They're not out with their hand out saying, what can I get from you? They're out saying, what can I help you with? So that's my impression of this young man, Clint Hooper. And I hope that by the end of this presentation, I have not lied to you, right? So Clint, come on, man. Come on the mic.
Hey, I appreciate the kind words. Let me get this video on real quick. How are y'all doing today? So appreciate the accolades, I do. And I'm sorry I'm looking a little tired today. I've got a couple little kids I just put down to bed. So a little bit about me. My name's Clint Hooper. I did not start out in this industry. I did not start out in finance. I was a combat medic for 8 years, deployed when I was much younger in another life, and then transitioned into ER medicine as a nurse. And so that's where I spent most of my career, is in healthcare, serving my communities, serving others, and leading for the most part everywhere I went. I found myself in situations where I wanted to mentor, I wanted to teach. It didn't matter what it was, whatever the job was, I wanted to teach others how to do that better and find an efficient way to operate. And that led me into the last 5 years of my healthcare career being in operations. And so covered the state of South Carolina with Fresenius Medical Care, dialysis company, large organization worldwide. Really passionate about serving that community of folks. I feel like they are a community that just is underserved in a big way. And that same mentality that I did in the ER kind of crossed over into that. And that's where I really found a love for the financial side of healthcare. Got into operations where I was covering 26 hospitals, had 11 clinics. And I'm really big into the home education for dialysis. And so education being the key word there, that's probably my driving force, is just education. That's kind of where I come from. I don't come from a sales background. I don't come from a real estate background. What I really love about doing lending is, taking and helping you cross those barriers that are in front of you, those hurdles, those things that are telling you no, and finding a way to say yes, or maybe not yet, but we can do this in 6 months, or we can do this in 3 months. Let me show you how we can do this. So I spent the first probably 6 months of last year just in sensory overload, learning loan products. And I went to my first meetup with a local guy here that does a lot of wholesaling. He was a guest speaker, Bob Shortsleeves. Some people may know him. And he invited me to see his presentation. And right then and there, in that room full of hungry investors trying to pour into one another and learn from each other, is where I realized that this is another underserved community, right? This is another undereducated community. It's like a needle in a haystack, finding somebody who's dependable that can close these creative options. And that's kind of where I thought that I might try to really learn everything I could about DSCR loans, delayed financing, among other things. Of course, my bread and butter is VA, FHA, conventional, your primary residence, construction. But this is a niche of mine that I really enjoy doing, and I hope you enjoy what I have to offer today. So let's get into it. So I titled this Exit Strategies and 1099 Friendly Loan Products because I'm teeing up to do this same presentation up in Charlotte, something around there. So I figured I'd play with it a little. I did get my MBA a couple of years ago to try to further my career in healthcare, and it's really helped out a lot here. So Tactical Mortgage is where I work. It's here in Fayetteville, North Carolina, home of Fort Bragg. And we'll get to it.
Are you sharing your screen?
No, I'm just looking at it, not sharing it.
No problem.
I got you. Share it for you. You ready for that?
Hey, if you want to do it, you got it.
Yeah. I probably need to do that part. There we go.
I see it now. Nice.
Let me put it in presentation mode real quick. All right. You just see the first slide.
Perfect. I see that beautiful blue.
Okay. That's right. That's our colors right there. All right. So this is geared toward those of you who've exhausted your 10 property limit using Fannie and Freddie Mae or Fannie Mae and Freddie Mac products, or are 1099 earners. As you know, Fannie Mae and Freddie Mac qualify you while looking at your income in regards to the debt you have and the debt you're about to have. And then they get a ratio. And if that ratio doesn't line up, you don't work. This is not going to work. And then, of course, your FICO score. With these right here, this is a vehicle for the right person in the right place at the right time. It is not my primary choice. If you can go conventional to get your products, go conventional, right? That cost of money is going to be cheaper, but they're going to have their restrictions. But once you've tapped that out, you've got to figure out a way to get funding. And a lot of folks are, buying with hard money, they're buying with cash, and then they're looking away. How do I get my cash back out of that deal that I just used from my HELOC to replenish that? Because cash offer, cash is king. Usually you're going to get that deal quicker. Or how can I burr this property? How can I take and rehab it and then get the refi it based on the new ARV, that after repair value, and realize that new value? So we're going to just talk about, folks that are in that category. So the two exit strategies that are most common, of course, is you buy it and you flip it. You 1031 exchange your profits and you put it into another venture, right? Or you buy and hold and you refinance it to a long-term loan and pay back what's owed with the possibility of taking some of that tax-free capital and putting it into your next venture. So let's talk about how we can do these two things. So refinance options. You've got two main options. You can do the delayed financing, or some will call it recoupment of funds if it's not a true delayed finance, but it's the same type of process. And then you've got your cash out refi. Now, when you do a cash out refi, that could be, to take and exit that hard money loan. You could take a single property in one of your portfolios and cash out refi it, take that cash and pay your hard money off. You can cash out refi the subject property, or you can even cross collateralize your property. So that's known as a portfolio loan. And that's nothing more than me taking 6-7 properties that are at least 150K in value a piece, lumping them all into one mortgage, taking the equity, combining all the equity, and taking out 70% of that equity to pay off all the notes. So you can have them now in one loan, one monthly payment, and then you're left with all that leftover from all those properties in one. So we do those as well. So those are the three main ways to kind of do your cash out refi. Now, delayed financing. So what is delayed financing? I'm just going to read it here. Delayed financing is the method for getting a mortgage after you've purchased a piece of real estate using cash. So you don't have a lien on that property. You've used cash to purchase it. But simply, delayed financing offers a way to purchase a home in which you pay cash up front, then quickly obtain that cash out refi to mortgage your property. So you got Bob, he got a HELOC over here. He took, 70 grand, bought this little house. He's rehabbed it, and now he wants to get his money out before he even rehabs it. He wants to get that cash right back out. You can simultaneously, while you're putting that cash offer in, you can be working the deal with me. So I can be submitting the loan, ordering the appraisal, and what they'll do is they'll give you 80% of that value, not to exceed what you've put into that property, to get your cash back out. So unlike a cash out refi, delayed financing is not going to have your 6-month seasoning. But the big downfall for delayed financing is you don't get to realize the new value, or say you got a really good deal on that property and got it for 60 and it's worth 150. They don't care. They're not going to go over what you initially invested into that property it's just recouping your funds. That's all that is. So the major requirement for delayed financing is the buyer did not open any mortgage, lien, or financing of any type. And I underline this, on the home they purchased. They don't care if you opened up a HELOC on another property in your portfolio and bought it. The key is this property cannot have a lien on it for it to be a delayed financing candidate. And so if it doesn't fall into that criteria, you're going to have to wait that 6-month timeline to do a cash out refi.
So Clint, you got that pause right there. Let me jump in right quick. So great information so far. And I know that some people may not understand that delayed financing, or why would somebody do that? So when you have, let's say you have 20, again, let's take in the situation of what it is. You already have 10 properties that you cannot do this no more with the bank. So that means that you have money coming in, you have cash flow, you're steady want to grow your portfolio, and you're leveraging your portfolio to acquire more properties. So this makes sense for a person that don't care about getting more money back when they refinance or they burr. This makes sense for a person that want to keep on growing their portfolio and their cash flow.
Or like if they have, sorry to interrupt you, but just to piggyback on that, I deal with a lot of folks that have several HELOCs, right? They're not tapped yet, but they're ready to use at any given time. So folks like that, they just care about replenishing that HELOC for the next purchase. And so that's what this avenue is for. They take the cash from the HELOC, they purchase the property. So it's got a nice attractive offer. It's cash. And then they want to get that cash right back, replenish the HELOC. So they're minimizing those interest only payments, and they can use that money for something else.
All right, you use the term. Let me go ahead and define it. HELOC, home equity line of credit. That means they got a lot of home equity line of credits. You have home equity line of credits when it's your personal home, and you have a lock when it's a business loan, a line of credit. So just for all the newbies that are listening, I want to make sure y'all kind of caught on to what's going on. And this is leverage for you because a lot of newbies that just start, you have a home that you've probably been staying in for 10 years or 15 years, and you have a HELOC you can get to get your money to get your first rental property. All right, brother.
Let's talk about a HELOC real quick, because this is good to have the conversation because it slows me down because I'm a fast talker. I'm drinking coffee at 9:20, and it's an important topic. So HELOCs, for those of you who don't understand what that is it's basically a credit line based on the equity of the home you have it on. So you're not getting charged any payments or anything while you had that available. It's just there. Then you go online, you transfer X amount of dollars to your account. Within 2 days, it's there. And then every month you have interest only payments on that balance until it's replenished. So it's like a cash credit card. Very, very good to have. And as much as I would love your business, and I do HELOCs, I'll tell you, if you want a good HELOC, before you come to a broker, before you go to anywhere, credit unions will generally have an attractive HELOC. There's a few out there that allow you to do it on investment properties and primary residence with fixed rates, variable rates. It just depends on the product, but definitely don't just go with one person. Do some homework, search your products, search your local banks. HELOCs are usually strong in a bank, not just any bank, but more of a credit union. Anything to add before I move on to the next slide there, T?
Just one piece. All right. You said, man, perfect. Thank you for breaking that down. Thank you for letting them know exactly that's something they want to lean forward for. And I want to just piggyback off the credit card part. Even better than a credit card because you don't have compound interest. It's even better because whatever you pay down, come back available. Everything you pay down. So if you got $30,000 HELOC and you only spent $15,000, you're only paying back interest only and that on the $15,000. You still have $15,000 available to go and buy another product and work on another product. And as you pay it down and you pay your money on it, guess what? You start getting more money available again. So you pay $5,000. Now you got $20,000 available. You pay another $5,000. Now you got $25,000. And then you pay that $5,000. Now you got $30,000 all available. So that's why this delayed financing strategy is huge because you ain't got to pay it in portions. You can pay it off in full and go buy you another property, another property, and you can move at the pace that you ain't got to worry about the 10 houses limit. All right, brother, go ahead. I got you.
Nope, very good. And it's true. Like the HELOC's a wonderful product. I mean, like I said, find you a good couple credit unions you can find that do HELOCs. You generally can find a good product for HELOC if that's what you're looking for. So let's talk about the sources. Remember I told you this is when for delayed financing, you're paying cash for a property. You're not putting a loan on that property. So what are some of the sources of funds that you can purchase a property for that'll still keep you eligible for a delayed financing deal? They can come from your savings accounts. They can come from investment or retirement accounts. They can be a personal loan. As long as that person giving you the loan doesn't put a lien on that property. It could be, of course, sale of assets and any combination of the above. And then a HELOC is, again, and I stress this over and over because people get it confused. Like, I don't care if that HELOC that you're getting it from has a lien on the property that it's associated with, not the one you're purchasing. So as long as the one you're purchasing is bought with cash and doesn't have a lien, you're good. Anything there to add before I move on?
No, brother, you good. All
right. So let's talk about cash out refi. So cash out refi using a DSCR loan. I get asked all the time, and I hear people explain this and call it a debt service credit ratio. It's a debt service coverage ratio. That's what it is. You're basically, the long and short of it, before I read this, is you need to be able to cover that debt with the money you're making. That's all it is. The debt being payment, interest, taxes, insurance, association dues, whatever comes out monthly needs to be covered by the market rent. So what they do, how do we figure out if the property rate DSCRs, as they say? You'll hear, does your property DSCR? What they're saying is the gross rents derived from the 1007 divided by your payment, interest, taxes, insurance, and association dues, known as PITI, that has to be usually a DSCR of 1.25. Different lenders have different requirements, but generally 1 to 1.25. you're going to get approved. What that basically tells the lender is that, hey, this property is going to break even or cash flow. That's all they care about. It's called asset-based lending. It's not borrower-based lending. All they care about is your FICO and if you have the money to have closing costs. Everything else is the asset determining if you're going to get approved or not. So the 1007, what is that? A 1007 is done in conjunction with the appraisal. So the appraiser comes in, he gives us a value, and with that, he gives us what the market rent should be. This is very important because people think, okay, if I have a low lease, if I have this property, it's got an active lease on it for $900 a month, it's under market value. I'll just let the appraiser, give us the new market value because it should be market rent should be $1,500. Well, that's not going to work. That lender is going to take your lease and he's going to take the market rents that the appraiser gives them, and he's going to use the lowest of the two. So before you come into doing something like this for a cash out refi on a property that you want to refi that you've had 6 months, make sure that those leases are already at market rent or what you think market rent's for, because you don't want that to be the cause of you not meeting your DSCR ratio. You don't want them using, the lower the numbers they come up with, and the lower the numbers being, your fault because you got them on a cheap lease. So make sure you've got those market rents covered. Make sure you've done what do you call them? Your project or your property manager is taking a look at those if you have one, and you've done a good analysis of what that property should rent for, and you've got good stable leases in place. This is, of course, completely different DSCR loan from your conventional loans. It's called a non-QM loan. It's a non-qualified mortgage, non-conforming mortgage. And again, we don't use your taxes. We don't use your income. The only thing they want to know about the borrower is your FICO score and experience level. The more experienced you are, the better your rates are. The higher your FICO, the better your rates are. Generally, we need a 620 plus. I'll tell you, a 650 is where you want to be for your FICO to get this done without any LTV hits. LTV hits, that means, like, say they would normally give you 75% of the value, but maybe you're a newbie and you have a credit score right under 650, you may only get 70%. That might not be enough to meet that $100,000 loan limit. So with a DSCR loan, we use your property's cash flow with the ratio I described above, gross rents divided by your PITIA. And if that equals 1 or higher, you got a cash flow on property and you get approved. Any questions about that? That's a lot of information if you've never heard the term DSCR.
So I'm gonna piggyback on it a little bit. I mean, it's a beautiful thing. You kind of laid out so much information. If anybody was listening, that is ridiculous. For one, you said, hey, make sure your lease amount for the last 6 months is at market rent. That means, hey, don't be going lowball, right? Don't be lowball. Then not only did you tell us that as a hint, you also said, hey, make sure you talk to a property manager in that area because they know who's market rent. They already know. So you gave out even the how, not just the what, but the how you get the answer. Property managers. Now, the other part he said that was awesome. Hey, it goes by experience. How much experience do you have? So guess what, guys? If you're a newbie, that's why you want to partner with people. That's why we better together. Because if you partner with a deal with myself, with Joe, guess what? That's your experience. That's your experience. That's why you have to partner with other people to make sure you're meeting standard, because once you show that you head in on that and deal on that, a percentage of that, now you can carry it over and you get a better percentage, or you get better rates based off the fact you did that so many times. All right, Clint, did I lie?
No, you're right, because they're going to ask you, how many properties have you bought and sold in the last 36 months? And I've done one of these deals for a brand new investor, and not only was he a brand new investor, he did not have a primary mortgage, which is unheard of. I was watching videos as I prepared for this just to see if I was missing anything, and I was watching videos on DSCR loans and just watching people break it down. And I've done this presentation a million times, but I just wanted to make sure I wasn't missing anything. And one of the common themes I heard was, you can't be new. That's not true. Not only can you not be new, you don't have to have a mortgage. If you have rented for the last 12 months with on-time payments, and I can get a verification of rent from your landlord saying you've made those payments, and this home is not close enough for you to occupy, because these loans have to be non-owner occupied. Being keyword, you cannot move into this property. These are straight up rental properties. They have to be. You can get approved for one of these loans as a new person. So say you don't have the income, right, to do this, but you haven't exhausted Fannie Mae, Freddie Mac, but you don't meet their requirements. You can still do this. So that's just something to hold on to. Don't think just because you're new, you can't do one of these. But it does behoove you to join up and partner, because like you said, you're building your resume. You now have a house under you, 2 houses under you, 3 houses under you, and now boom, you're in the experienced tier category, and they will give you a percentage of a rate betterment for that. So
hold on, you got one question, brother.
Yeah.
I'm gonna let him unmute and exit himself, because he like to talk.
Yeah, no, true. Go ahead.
Hey, thanks for the information, man. But I like this process, because how is it better than the FHA?
So it's not.
It's not?
No, this is like I said, this is a vehicle for the right place at the right time. If you can qualify for conventional FHA for their DTI needs, then you need to do that. You absolutely need to do that. And I do those as well. But the difference is you're limited, right? So like say if you're somebody who's wanting to close in an LLC, you can't do that with an FHA or a conventional loan. You have to vest that in your name. But if you want to exhaust your FHA and conventional options before you even come over into this realm. This realm is to continue growing. This is when you've exhausted those other lending options. I'll be the first to tell you, go for the cheapest cost of money. Absolutely. But there's going to come a time when you can't qualify, but maybe you're shielding your income because now you're 1099, or you've got your rentals, but on your Schedule E at the end of the year, you're claiming a loss. So you think you're offsetting your debt. And I'm going to get into that because it's important. Let's get into it now. If you buy a property and you get it under contract, you get it cash flowing, you get a tenant in there, and the mortgage on that property is $1,200 a month, and the rent you're charging is $1,200 a month. You go to buy another property within the same year, they're going to ask you for a lease, and they're going to give you credit for 75% of that lease to offset the debt when they calculate your debt to income ratio. So now they're not going to count that whole mortgage against you. They're going to let that lease count for some. Now, fast forward, it's tax time. You hit your tax guy. You don't want to get taxed. Now that property is on your Schedule E and he shows you have a loss. Well, now it's the next year and you're trying to buy another property, and we're not asking for your leases anymore because those properties have hit your Schedule E on your tax form. So now we have to look at your Schedule E to see how much income you're making off those properties so we can offset your debt. And like most, if you've hidden your income and shielded it some with a good CPA, like they're hired to do, you're not going to be able to offset that debt anymore. And now you're not going to qualify. So if you are buying using conventional lending, you want to do that within the same year. And if you plan on buying more the next year, you need to make sure you have a talk with your tax guy or gal and say, hey, I want to buy more properties, so I need to show some income to offset this debt until I'm ready to shield myself again. So think about that when you are buying with those conventional methods. But no, absolutely. That was Vincent Wright, I believe. You're 100%. Use that. Use it.
All right, thank you.
Anyone else?
Nope, that's it for right now. If anybody else, you can raise your hand or you can put something in the chat box. If I see it, I'll bring it up.
But no, I want to reiterate and that's how I started. Definitely use those routes before you even think DSCR. This is so you can continue to grow, or for those of you who can't meet those debt to income requirements, but you've got the plan and skill set to do this. So
I'm gonna pick it on that one right there quick. Because I don't reason why I'm gonna do that, because I know that you got some people that want to keep their funds and their money for buy their personal home. They want to put all their money in their personal. So if you are a newbie and you starting off saying, hey, I want to do this, instead of doing that, conventional, because you want to keep your debt to income and all the stuff, you don't want nothing to count against you, then that's maybe work great for that person, right?
Absolutely. Well, and the way this is going to work when you come to me, that good looking dude, he's a little better than the guy on your camera, but that is me too. And that's the one you're going to call. to review your scenario. We're going to go over it. I'm going to pull the tax record. I'm going to look at that property. I've got a program. And so if y'all want me to run these scenarios for you, just if you're wondering what market rent should be on your property, I've got an app that kind of just shows me what those market rents should be and what the median value of that property should be. So I'm going to look every bit of that up. Because I don't like surprises. I like to know that the deal's approved before I get it approved by the underwriter, because I'm not going to waste your time or your money. So we're going to review that entire scenario. I'm going to make sure. Another thing, like if you're buying a property and say it's been converted to a multifamily, well, you need to make sure that you've looked at that property record card at the county tax website. You want to make sure that it's zoned as a multifamily. If it's zoned as a single family, you're going to have a problem. We're going to get through this. You think you've got this multifamily. We go to the appraiser. The appraiser is going to appraise it and it doesn't match the tax card. You're going to have to figure out how to get it rezoned. So know every aspect of your deal, know how it's zoned, make sure that it matches what the property you're buying says it is. And then have a good idea of what the value should be, what it could be with your rehabs or whatever that is. And when you're building out your analysis of however you analyze your property values, when you're building in costs to see how much rent you need to make, I'd kind of build that off at an 8.5% interest rate. Kind of plan for that so you can kind of cover all your costs associated with this. So we're going to review your scenario. You're going to give me a call. You're going to tell me the property you want. You're going to give me an idea what your FICO score is, and tell me what you want to do with it. And we'll determine if we think it's a good deal. If we think it's a good deal, I'll give you the application to fill out. I'll pull your credit. We'll order an appraisal with the 1007. They'll send you a link and you'll pay for it. We won't do this until we feel that this is without a doubt a good deal, because once you pay for this appraisal when it's done, say it doesn't meet, that's not refundable. So that's why it's very important that we vet this property and make sure that we feel it's a good one. And then we're going to gather all the docs we need and we're going to submit it to the lender. The appraisal is going to come back. The 1007 is going to come back, and then the lender is going to analyze that. And what they're going to do is they're going to make sure that whatever they quoted you for a rate and that payment, that insurance and that taxes, that whole amount you're paying monthly is covered by the market rent. And if it is, then it DSCRs and you're approved. I generally get these done in 30 days or less. I will tell you they're tedious. They're hard loans. And that's why people say they can do these, but I self-process every one of these. I have a processor. I don't let her touch these. She does all of my normal loans, but I do these. I handheld these things from start to finish. I order the appraisal. I order the title. I do all of the conditions. And I do portfolio loans. I do fix and flip, every bit of them, because they are very tedious and there's a lot of moving parts. So I move at the speed of you. So I'll tell you what we need up front so we can have a quick close, but it's up to you to make sure you do your part, but I'm here to help you along the way. So I'm going to show you on this last slide, really some of the important docs for those who want to close in a business entity. You can screenshot them and I'll send this presentation to Terrence so he can send it out to y'all. Cause like I said, it's not proprietary. It's just good information. But again, I tell you all that because it's very important to not sleep on getting these conditions to me, because what happens is I submit it to an underwriter and they're going to give me 2 pages of conditions. I wish I had some to show you, but they're nuts. I mean, there's a lot of little things they want. I can do them in my sleep at this point. I've done about 10 of them already this year. And when we get these, we can't submit these like and piecemeal it together. So what we're going to need to do is get all these conditions and submit them at one time, or this thing will drag out. So these are usually a 30-day close or less. But again, we move at the speed of you. So as fast as you can get me the items that I need, that's as fast as we can get you closed. And then we go to this, just a recap on seasoning real quick. So I mentioned seasoning earlier when I talked about delayed financing versus refi. So if you go, Fannie Mae's changing their rules, and I think it goes in effect in April or May, but you've got to be on note or deed for a year before you can do a cash out refi. So seasoning is basically the amount of time that your name has been on the note or the deed. Most lenders are going to require 6-month seasoning for your regular cash out refi, and they'll give you 75% of the new value. So say you buy this property for 80, you put 30 grand into it. It's worth 160 now just because of the work you did to it. The only way for you to get credit for 160 grand property value is to wait 6 months. Once you hit the 6-month mark, they'll give you 75% of that new value. Now, if it's within 90 days and you've had a cash purchase, you could do delayed financing. Delayed financing, again, they're going to give you 80%, up to 80%. They're not going to give you 80, they're going to give you up to 80%, as long as it doesn't exceed what you purchased that property for, and just to give you a recoupment of funds. So again, you've got cash out refi, you wait 6 months if you want to see the whole value and get the payoff plus some cash out. If you just want to recoup the funds and do the delayed financing, they're just going to do just that, recoup the funds you put in to purchase that property, so you can then go do it again. So pros and cons, Vincent, this is kind of where our conversation came in. Like I said, this is not right for every person and every stage you're in of investing. But if you have tapped out and you don't meet debt to income requirements, this is going to be your route. This is going to be the Corvette that gets you from point A to point B. Generally, we're going to have some slightly higher rates, so plan for it. When you're doing your analysis of how much you're going to purchase for, what you're going to put into the property, and what you're going to charge for rent, plan for around 8.5%, 9%. Go heavy on the interest rate so you can build that into your pricing. And most all these products have prepayment penalties. It's not attractive at all, but they do. Almost every DSCR lender, you can waive it, but it's not worth it in what it's going to do for your rate. So the most common prepayment penalties are 3 to 5 years, and they're generally 5%. So what that means is if you sell that property or refinance it within that first 5 years, you're going to have a penalty of 5% multiplied by whatever that outstanding balance is that you're going to have to pay them on top of what you owe them. Most people that are buying and holding really don't care because they've got their initial burr out of it. So it's fine. They're buying and holding. So it just doesn't matter. And then after 3 to 5 years, you can refi it or do whatever you want with it. But it's a great option. It's a great option if like your rental properties make up the majority of your income stream and DTI is an issue, or again, right, as you see, your tax filings aren't going to support the income needed and are going to disqualify you from getting that property. So there's no limit to how many DSCR loans you can have at one time. You can literally have 4 DSCR loans going with me at one time. They don't care. As long as you've got the assets to show for closing costs, you're good. And with a cash out refi, you don't need to show any assets. They'll just take that out of your money you're getting out of it. And then you can use these loans to build up a large investment portfolio pretty quick. I got a guy who I met probably last October. He liquidated everything he had in New York. And we started talking. He said, Clint, it was like December. He said, I'm going to hit 2023 and I'm going to hit it hard. I'm going to buy property every month. I didn't know him from Adam, but we good relationship. Well, sure. December, man, he was already showing me a property he wanted. January, he was closing on it. In March, he was closing on another. He's just finding them and buying them, So there's just no limit to the properties, and he's building back up his portfolio with this product. Any questions about any of these things I spoke on, or anything you'd like me to expand on?
Nah, man, I think you hit them pretty good and where they can understand it. And I think you did great.
All right, so here's some general guidelines. I just covered up to 4 units. I did throw a little 5 to 29 unit in here, but know this, what I'm about to speak about here also applies to commercial properties. I do commercial as well, and they have the same, they do asset-based lending the same way. It's all about the cash flow and the net operating income. So that property is going to cash flow. These are pretty much similar terms I can give you on commercial products as well. So property types, SFRs, that's a single family resident, condo, townhome, 2 to 4 units. Now, don't think that a multifamily has to be attached. I'm doing one right now. There's 4 single family dwellings on one parcel, and the parcel is zoned for multifamily. So it meets the definition of a multifamily. They're just detached. So like, again, that's another situation just to make sure the tax card reads the same as the property. I did throw the 5 to 29 unit one in here. Just know that for those, instead of 75%, I think it's around 70% is what your financing is on. So loan terms, we've got your 30-year amortized in term, which is the 5/1 and 7/1 hybrid. All that is 5 years, you're in a fixed rate, and then every year after that, it's variable. Or the 7/1, which is 7 years, you're set at that rate, and then every year it changes after that. The beautiful thing about that is if you get a better rate with a 5/1 and your prepayment penalty's up after 5 years, you can just refinance it into a better product because you don't have a penalty to do so. And then you can also do a 30-year fixed, which is what most folks do. Just know that there's no escrow waivers with these loans. What that means is escrow is nothing more than where the mortgage company makes you pay them a monthly tax and insurance amount as well, so they can pay your insurance and taxes every year for you. So they'll require that, you know, you do that along with the payment. This is one I like too, are these interest only options. So some folks, it depends on your business model. Everybody's got a different model. Some folks really just don't care about paying that off. They just want a cash flow on it every month. And then, you know, after 5 years, they may just flip it, you know, and that's what this is designed for. You know, you're only paying interest only for 5 years, and then the last 25 is amortized or over 30 years. So you got a 30-year AM loan for the last 25 years. And then you've got a 10-year interest only. So you have 10 years of interest only payments and then 30 years of regular fixed rate payments. And that's for when you're trying to decrease the amount of your payment each month so you can increase your cash flow. It just, like I said, it fits the right model. It just depends what you're doing. Everybody's got their model. As long as they're being consistent and following it, we've got something that'll fit it. So for your refi cash out, I've been talking a while, and I know some of it can just turn into like Homer Simpson going blah, 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 but this is very important. So wake up and listen to this part, because when you're planning, if say you're getting hard money from a hard money lender and you're planning and you're in your mind, you're like, oh, it's fine. I'm going to refi this, get a cash out refinance, and I'll pay that hard money off. Well, that's great, but you need to know what those minimum loan amounts are. You need to know what those exit strategies are when you're planning for your hard money purchase. Because right now, with the way the world's been turned upside down, 75K loans, they're there, but they're rare. Most of these lenders require a minimum $100,000 loan, not property value, but loan. So if you're refinancing a property that you're doing some work on after 6 months, you want to make sure that the ARV, or your after repair value, is going to be high enough for 75% of it to be at least 100 grand. So quick math, that after repair value needs to be at least $134,000 for you to even think about using a DSCR loan as an exit strategy, because 75% of 134 is going to get you right there to the 100,000 mark. Again, you go into the $70,000, $80,000 property, you know it's going to value at 160, 150. That's great. You're going to be fine, but you want to know what that after repair value is going to be. If it's going to fall below 134, this may not be your exit strategy. So you better plan for a different one. And then you've got their rate and term limited cash out for recoupment of funds or delayed financing. They will go up to 80%. So you don't need as high of a value. If you're just going to pay cash and you need to get your cash right back out, you just need to make sure that total value of the investment's 125. So 125 will get it done for delayed financing. 134 value will get it done for a cash out refi after 6 months. Those are two very important numbers to make sure you have kind of solidified in your memory. And then if you want to close in an LLC or S Corp or business entity, it will require you to do the ACH form payments where they do the automatic withdrawals. So just kind of be prepared for that. Any questions about some of that I hit? Because that last bullet there is probably the most important.
Nope, I think we're good to go, brother.
All right, and this is the last slide. I just want to close with this, just because for all those that do have an LLC and just are wondering, like, what docs is he talking about? Like, what do I need to have ready? This is probably the most important thing to have ready on the front end, because they're going to do the entity review by a third party. So these lenders have like a legal team. They're going to send all of your entity documentation over there and check it all out, make sure it's legitimate. And that takes a little bit. So I like to have that done on the front end. So you can screenshot this. And again, I'll send this out to Terrence, but your business entity documentation, I need your operating agreement or bylaws. I need your certificate of formation or articles of organization. Certificate of good standing. You can also just go to the LLC site and just show the page that's active and screenshot it. That usually will get it done. And then of course the name and principal residence and home address of the person signing as the personal guarantee. These do require a personal guarantee for the mortgage payment. Even though you're closing in an LLC, you're still responsible for making sure that those mortgages get paid. And then of course your EIN number. Those are the big docs that you want to have on standby if you're wanting to, do a deal, invest it in an LLC. Make sure you have all these documents together. And if you need help in getting some of these documents together, like the operating agreement, there's a forms/NC for North Carolina, and other states have their own version too. Excuse me. It's a free site that'll allow you to go in there and put this together. I'm sorry about that. But that's about it. In a nutshell, that's kind of what DSCR lending is. That's a little bit about their products and just kind of how they work, how they approve you and kind of how they go from start to finish. So I do appreciate your time tonight and let me share with you. And I hope that if you do have any questions that you give me a call, email, text, whatever you want. I'd be glad to share more about this one-on-one with you. And now I'll open it up for any questions or discussions.
No, man, absolutely. I just want to say thank you again for bringing it. I mean, I asked you to do this because, I knew I had a process going on. And I just kind of want to, have somebody in place that I knew was going to bring great information, great content, and be a personal person that can deliver a message without, being cocky. And, I'm kind of cocky.
Oh yeah, no, absolutely. I'm not big enough to be cocky, and it's not my character either, but I'm still in here growing, learning. And I tell you, it's rare to find a guy that does, and I see your hand up, Vincent. I'm going to get to you right after this, but I really have made it my point to try to have everything I can under one roof, one umbrella. Right now I'm in the process of funding a deal for a builder and developer. We've got money for builders. We've got money for investors. I've done a couple portfolio loans, and then I just did a construction loan, a one-time closed construction loan. And then of course, all the Fannie Mae, FHA, VA conventional. So, definitely try to learn as much as possible to keep growing and to keep serving the local community and helping them kind of accomplish their goals and dreams.
That's exactly why I asked you to be a part of this. And I want to try and find a way to help you. Because I mean, anybody that I like and I see that stays similar to me with being about the people. I definitely want to highlight them and push your business to you, for you, with you, and assist you growing, man. Because if you're out here helping people, like you said from the beginning, and for those who got on a little late, Clint said, hey, as a nurse, I found that some people is underserved in the dialysis world. And now he said as a financial advisor now, pretty much, he's not an advisor, I'm giving him a title, but as a financial professional, he's finding now that the real estate world of investors are underserved. So he said that he's taking this on personally. He also said with his own mouth that, hey, I got a process, but I don't let the process touch this one. I hand deliver this one for you. And everything I said before he started talking was, I feel like this person have a personal connection with the people he work with. He wants them to win, and he kind of find a way to serve you and not look at how much he's getting paid for it. He's going to do his job, and he's going to do a job where the money is going to come because he's bringing sincerity. He bringing his hard work, his dedication. And like he just said, I'm trying to learn everything to be an all shop in one shop. I want to do residents, I want to do investors, and I want to bring somebody that got some, hey, they hear and no, hell, let me see if I can find a yes. So man, kudos to you for being the man you are, the father you are, the brother you are to me now, because I feel like you're my brother. Whenever you go to paint, man, if you want me to ride down there with you, man, I'll love to ride down with you. Hopefully I'll be healed by then. I ain't gonna drive that long, but I'll ride with you. And be your yes man in the corner. I'll be your hype man. Hey, hey.
Awesome. Like I said, I appreciate it. It's a great opportunity. And like I said, I hope it helps some of you. And Vincent, I'm going to get to you real quick. Go ahead and unmute and ask me that question because you've had your hand up for a bit there.
Oh,
Go ahead, Vincent.
it didn't break or nothing, so you good.
You better not be having another echoing over here.
Hey, I already had my rotating cuff on my shoulder, so I'm good over here now. But anyway, only question I had, you mentioned a little bit about a construction loan because I did a hard money lender before, and I was on the process of do a construction, but it didn't go through. So can you touch a little bit about your construction loan?
Yeah, so the ones I'm primarily doing right now are one-time closed construction loans, primarily for like a primary residence, and we do VA and conventional. The VA is, of course, by far the most attractive because there's no interim interest payments, and basically we underwrite the construction process and the borrower at the same time, close the loan before ground breaks, and then loan funds. And then the builder can start building on the property, and it's based on a reimbursement draw program. But we also have, if you've got a builder with a builder resume with experience, I've got capital for builders. It's around 11.5% for somebody in the high sevens, and it's interest only, while you're building. And they will actually cover horizontal and vertical development of those properties. So if you're building a neighborhood or 3 or 4 properties, it's a $500,000 minimum loan amount. And they'll cover, like I said, the development of the property, running of the lines, and the vertical construction. And then they have a bigger product that's a $500,000. No, it's a $5 million loan limit. And those are for your big, heavy developers, doing an entire neighborhood. And what's cool about that product is, you get that it's a huge amount of money up front. It's got a heavy cost up front, but those guys can that's one deal, because what they do is they'll say they sell half those units, then they can recycle those funds. They don't have to apply for a whole new loan. They can just keep recycling the funds as long as they're building in the same neighborhood or zip code or MSA, that population area. So definitely have some products that I can talk to you one off, that are more suited for exactly your purpose, that are out there.
Okay, sounds good, because I'm trying to learn all the strategies myself. So from the construction to the, Fannie Macs to the 203K loans, I'm trying to learn all of myself.
Yeah, and I'm glad you mentioned that FHA 203K loan. I got to find a lender that does it because I want to do one, like this construction loan I just did. It was the most painful experience in my entire life. And it was horrible. It was with a rough lender, but it was the only lender that did those type of loans at the time. Since then, I have a really big house lender that's now opening up and doing them. But I enjoy a challenge because like the more, I feel like if you're not outside of your comfort zone, you're not growing. If you get complacent, then, and that's fine. Like it's all about who you are. Like for me, I have to be uncomfortable all the time. And if I'm uncomfortable, I need to really feel a little lost in what I'm doing. If I don't feel a little lost, then I'm not going to be hungry to figure it out and learn it. And so I try to learn these products and to try to grow my portfolio of lending options. And that FHA 2 or 3K loan is the next one I'd like to tackle. I just got to find a lender that does them.
Cool. Okay, we'll be talking to you. I appreciate
yes, sir.
You.
No, absolutely. Thanks for the questions, Mr. Wright.
Listen, you did not ask one of the questions I thought you were going to ask too, man. I thought you were going to ask, is this nationwide?
Yeah, so that's the good thing is right now, I'm limited to my primary resident lending because my boss has been doing this 20 years and he just started his own brokerage. And that's why, he approached me last year when he kind of saw that I was just not happy in my place of business. And so we're kind of, we're just doing all the new lender stuff. We're going correspondence so we can lend our own money, and we're just getting all these new certifications. And hopefully over the next year, we'll start branching back out. But these products I could do nationwide. I could do in any state. Because they're like commercial products, but they're not. They're like a form of them, and they're not regulated the same. That's why they can allow different items. So you don't have to be in North Carolina for me to do these for you. I can do them in any state. Just about. Some lenders have like some certain state specifics they can't do, but for the most part, I can help you out no matter what state you're doing.
Perfect. That's the one portion that I had thought about it earlier, but I thought Vincent probably actually, because I know he's in Louisiana, Arkansas, Texas, network down there. So definitely doing that.
Well, and that, also, I know I talked a lot about LLC. You don't have to have an LLC to do these. They're open to you whether you have an LLC or not. They just allow you to vest in an LLC if that's what you want to do. So don't think because you don't have an LLC, you can't do these. Now, you do have to do an LLC if you're going to do a fix and flip or a bridge loan. You have to, and a bridge loan is nothing more than a long fix and flip. So you can do it like, say you're just getting this property that is going to be worth a lot, but it just needs a full rehab. You can do an interest only bridge loan to just kind of get it going. And then once it's all cash flowing and right, we can do a refi and exit out of that. But those had to be done in entities. But if you're just buying or refinancing, one of these property types I spoke of, 2 to 4 units, 1 unit, condo, townhome, you can do it in your name, or you can do it in an entity, and you still won't have to show income or anything like that. The property and your FICO score plus experience is what's going to get you the rate.
Awesome. Anybody else have any questions? I know I kind of, guys, I told Mr. Clint that I was going to do that, kind of chime in every once in a while to make sure
Glad
that,
you did.
Yeah, it just make it interesting and make you feel like you ain't talking to yourself.
When it's hard, it's, I think I'm a good speaker in public. I love talking and running my mouth, but on the computer, it's another world. So it's nice to have some interaction because it grounds you and brings you back into conversation mode,
Absolutely. I'm gonna let someone unmute. I ain't gonna mess your name up. Go ahead.
Oh, sorry.
Hey,
Can you hear me?
I can.
I'm so sorry. I'm really bad with this.
No, you're perfect. I can hear you
I
clear.
think you
Your hand and unmuted without any issues.
I think you had a really good information. I just needed to know, because that's my issue right now, is my DTI, and I'm trying to find a lender who can work around that, as far as like, DSCR or cash flow and how that works. So I just didn't know like what company you work for and what your contact information was.
Yeah, and Terrence, do you have everybody's email where you can shoot them this out, or you want me to put it in the chat real quick?
Yeah, put it in the chat real quick so they can hear it absolutely now. And then with the email, did you already email me the other piece? The PowerPoint?
No, I didn't yet.
Yeah, once you do that, I'll send an email out to everybody that registered. So okay, I'm gonna try and say your name, Gargata. Let me unmute you. Where are you located at?
Kansas City in the house.
Kansas. Okay. You happy now? Y'all some Super Bowl champs.
That's right.
Well, awesome sauce. How did you come across us?
Oh, actually, I've been seeing you on Meetup for a while now, and I've been, I've seen a couple of your meetups, but yeah, just meetup.com.
Awesome.
Well,
awesome. Go ahead.
And I'll tell you, if you want, I can't lend I can't lend yet like a normal conventional Fannie Mae or Freddie Mac. But regardless of that, if you want to give me a call, you can pull your Credit Karma up and tell me what's hit on Credit Karma. And that's what I like to look at. I like to play around like, hey, if we pay this off, we can bring your DTI down to this. Like there's ways, we just need to figure out how to bring your DTI in.
Okay.
If some of those debts you can kind of take and maybe, I don't know if you're married or not, like putting your husband's name and take them out of your name, there's ways to play with that,
Okay.
hitting you so you can bring your debt to income down. Because all debt to income is, just a quick brief summary of this, is they don't care about your electric bill, your house, your any of that stuff. They care about what reports to credit. If you had to get a credit check to acquire that debt, it reports. So they're going to take your monthly minimum obligations. That means your minimum credit card payment, your car payment, your house payment, whatever those payments are, they're going to add them all up. And then they're going to add the proposed monthly bill that you're getting quoted and divide that by your monthly gross income, not your after taxes, but your monthly gross income. And generally you wanted the number to be 45 or 40% or lower for your normal conventional, your loan products. You can go higher DTIs if you have like a ton of money in the bank that shows reserves, they'll allow you to go higher and a high FICO, but that's really where it's at. So if you can take and get your credit card utilization down below 30%, or you can take and refinance a car that maybe you've got on a 4-year loan and do it on a 7-year loan, and you can still pay the same payments you were paying on that 4-year loan to pay it off quicker, but on paper, you're not obligated for that. You're obligated to that lower payment. Now you have more room. So there's little things you can do to play with that.
Wow, that's very interesting. So is rental income also included in the gross monthly income, or is that not included?
So this is where it's fishy. So rental income, they'll give you 75%. Are you talking about like if you have a rental property?
Yes.
Yeah, so they'll give you 75%. So say, to make it easy, say you rent that property out for $100 a month. Well, they'll give you credit for $75 a month.
Oh, I see. Okay.
Now $100 a month isn't hitting your debt to income. $25 a month is hitting your debt to income.
Okay.
But the
Well,
caveat,
I don't have a rental property, but I was just wondering.
well, when you do like that, that's only good for the first year. Once you claim that property, that rental property on taxes, it then up on what's called a Schedule E. It's just one of the docs in your tax forms. And once you start depreciating and deducting this and deducting that, whatever that net income is on your Schedule E is what you're going to get credit for. And that's where you have to have that conversation with your tax person. Say, listen, I need to show all my income because I'm trying to buy some more properties, or I want to shield my income and I don't care about it, because you want to buy those in the same year that you acquired them, so you can kind of wash the debt, they say, with the lease amount. So the timing is everything.
Timing's everything. Okay, interesting. There's a lot to learn. And then if you say that you own a property or you purchase a property within a business entity or an LLC, they don't take into account your income, or they're not looking at your paychecks or your W-2.
No.
Okay.
No,
Gotcha.
and that's why the rates are inflated, right? Because they're taking a bigger risk, they're saying, okay, we're going to lend this person this money because they had this X amount of experience, this FICO score. And when we did the appraisal, it looks like it's valuable enough to cover the debt. It looks like she should make enough in rent to at least make her payments each month. That's what they're looking for.
Okay. I think the problem I have is I have a property that I purchased in August that's hurting my DTI. So if I put that in an LLC, will that free up some room for me to apply for?
The only way that wouldn't show up is if you refinance that into a non-recourse loan, which they're few and far between, and they usually are rough. So a non-recourse loan means your personal name has nothing to do with it, and now it's in your business's name and your business's EIN.
Oh,
security.
okay.
So you can quit claim deed it all you want over to your LLC, but is in your name, and that debt is in your name and associated with your social. So that will not work.
Oh, I see. Interesting. Really good information. Thank you so much.
Yeah, no problem. No problem.
Spot on, man. That was great information. A lot of details, a lot of actual steps, and a lot of things that I was over here taking notes, man. I was over here writing it up.
and I mean it. Like when I say you can call me anytime, I don't really have an off sign. I mean, I have 4 children from kindergarten to college, and I'm helping coach this year for the first time in some baseball because this new career has allowed me to have that time with the children. But other than nights I'm coaching baseball, I'm working, because, this is how I make my money. This is how I feed my family. And I do this all day, all night. I have a lot of freedom and flexibility, but usually evenings are when I am working the most, because that's when people are off. They're able to call me. So I try to make it my business to be available for you on the weekend after you get off work. So if y'all have questions or some of this was like clear as mud, call me. I mean it. Take the number, save it, give me a call. I don't care if I can even lend to you or make money off of your deal. That's not what it's about. I'll be glad to educate you on what we do and how you can get approved with whoever you're going with.
And that's exactly what I said before I started, guys. If you heard me at the beginning, This young man seems like he want to serve others and help others. And that's why I asked him to be on this call, because he's like-minded. And when you're around like-minded people, you can become a giant with giants. So thank you so much again for tonight. I think you did a fantastic job. I still, like I said, the invite for me to ride with you down there to the next
Hey,
paint.
man.
I got you, man. I'm on it. And look, everybody that was on the call, please go in the chat box. It's at the bottom of your screen. Click on it. I put the Facebook community in there. If you want to replay to this, you can get that Facebook community. It'll be playing in my Why Wait to Be Great community, as well as Clint information in there. And then I'm going to put this up on Investing Now 2021 YouTube channel later on. And if you registered, I got your email address, so I should be able to send you all this, because it should have been tagged with Clint's name. So Clint, man, fantastic job. We're 10 minutes over, man. You did your thing tonight, and I appreciate it. And you're welcome back anytime. And as you get those new products, man, you just, if you want to do a practice run with us, you welcome any Mondays you want.
I appreciate it. And thank you all for your time and attending. And I hope you got something out of it.
Peace.
All right.